Hey there, everyone. Happy holidays from Stock Charts TV. I'm Dave Keller, the Chief Market Strategist here at stockcharts.com, and welcome to our 2024 Market Outlook. 2023 has been a fascinatingly challenging year, I think, for a lot of investors. We've had upswings, we've had downswings, we've had a lot to get excited about, a lot to get nervous about, new swing highs, new swing lows, but at the end of the year, November, December, very much in a position of strength. So a lot of questions as we think about geopolitical risks, think about the overall market environment, breadth conditions, momentum conditions, the overall trend phase and where we're at. We have a lot of questions to ask. Luckily, we have three fantastic guest panelists to help us make sense of these markets. Welcome to each of you. I wanted to start with Mish Schneider, Chief Strategist at MarketGauge, coming to us from Santa Fe, New Mexico. Mish, happy holidays. Welcome to the show. How are you?
Well, except for having a flu, which I think half the country does, I'm feeling pretty damn good right now. Thanks for having me on.
We're navigating the seasonal tendencies in the market and the seasonal tendencies in healthcare issues. So thank you for boldly coming on, being a little under the weather, but we really appreciate you sharing some thoughts with us about the year to come. Jeff Huge is the Chief Investment Officer at JWH Investments, coming to us from a snowless Minneapolis, Minnesota. Jeff, how are you these days, and happy holidays?
Thanks, Dave. I'm doing great, and the same to you.
No, really excited, Jeff. You as also have been a frequent guest on my show, The Final Bar. Really appreciated your thoughts along the way. Really interested to see what you think about the 12 months lying ahead of us. Julius DeKempener is the founder of RRG Research, a senior technical analyst here at Stock Charts. Recently back in Amsterdam after visiting us here in Redmond, Washington. We interviewed you here on the set last week. Have you adjusted back to Amsterdam time just yet, Julius?
Just barely. I arrived back my afternoon yesterday, so like 3 p.m. Woke up increasingly early, crazy early this morning. Been on all day, and so we're doing this now, and it's what is it, like 7-ish p.m. for me. So I'm feeling it, but I'm good.
And we should note, everyone, we did have the Stock Charts holiday party on Sunday, which Julius attended, and then got on the plane soon after to head back to Amsterdam. So thanks for coming on, Julius.
Yeah, that might have been a little bit of the cause as well.
Well, it was a festive time for all, Julius. I'm glad you were there for sure.
It was.
So, guys, as we get started here, what we're going to do is talk in our 2024 market outlook. I have a series of questions which we're going to go through, just thinking about where your head is at. And what our goal with this one is to just have people, give them an opportunity to get inside your head a bit, see what themes, what patterns you're looking for, give them some actionable ideas, things to keep in mind as they're trying to navigate these markets in 2024. Mish, we're going to start with you. When you think about the market conditions here in December, obviously November and December, pretty strong coming out of the October low. Where is your head at as we begin 2024?
Well, there's so many aspects that I can talk about to answer that question, so I'm going to try to keep it as simple as possible. Clearly, the anticipation of lowering the interest rates, I think, was the fuel to get us to this point. But what's also so interesting is that I came into 2023 using the metaphor that you can't hunt with the hounds and run with the rabbits. And that is exactly what 2023 was all about. Everybody who hunted with the hounds looking for trouble missed the escape with the rabbit. And that's clearly what we've seen, these tremendous moves forward. So what's so interesting is that theme is going to completely shift as we get into 2024. We're now going into the year of the dragon. This was a year of the rabbit. We're going to go into the year of the dragon. And so I came up with a metaphor for that. And that is, if you can't stand the heat, don't tickle the dragon. So if we take a look at what that means for the S&P and for the market, essentially that to me tells me that there will be times where the heat will actually tickle this dragon and people could get into a lot of trouble anticipating that the old formulas that we've seen, low interest rates means higher stock market, better economy, will continue to be the theme. And it may not be. So in terms of the S&P, clearly looking at a chart, I think 4,600 is maybe your floor here to look at, in that if we break down under that Possibly we see a more bigger correction. Can we get to 5,000 or 5,100 by some are predicting? Yeah. But that is not the most interesting thing for me in the market. What's most interesting, and I know we'll get into, is really have we become too complacent in terms of fixing the world's inflation, fixing the world's geopolitical situation, and fixing so many of the other type credit events, debt, et cetera, that we still have very much in terms of being able to tickle that dragon in 2024.
It's interesting. You hit on a couple things. I hope we have time to explore a little further. Interest rates, obviously a big part of the story here, and 10-year yield pulling back from 5% down to around 4%, certainly giving a big upside boost to growth stocks here. Jeff, could I get your sort of intro thoughts? And I'll phrase my question this way because I think I know where your head is at, having had some conversations with you recently. I was scanning this morning, a lot of stocks making new highs, new swing highs, very few making new swing lows. Breadth conditions at extreme levels still here in mid-December. Is that a good thing or a bad thing in your mind as we sort of get started with 2024?
Well, I think it's indicative of the neighborhood that we're in right now, Dave, and that neighborhood is one of extreme bullish sentiment, a bullish sentiment extreme that, we haven't seen really since July. And, potentially maybe it even exceeds what we saw at the 2021, 2022 highs in some respects, with respect to positioning by CTAs at an all-time record extreme right now, positive gamma exposure by options dealers, all-time record highs. We've got the AAII bull bear survey. Bulls minus the bears is now at a 3-year high. So, that leads me to believe that, not only are we late cycle in the economy, not only are stocks very richly valued, but investors are all in as far as their optimism and enthusiasm about the market. And that setup is a dangerous situation. And so, our view going into the year, next year is really be prepared for a double top situation. Much the way we saw the S&P kind of squeak above the 2000 highs in 2007 by about 1.5%, we may see the S&P just squeak above those 2022 highs. And if it is 1.5%, that'd get us to around, say, 4,900 on the S&P, at which point we could see a complete reversal as people capitulate at that point, because there's really no support from valuations and fundamentals. In fact, the entire 2023 advance was nothing more than PE multiple expansion. Earnings may actually come in below 2022 levels. We won't know until we see the fourth quarter numbers, and analyst revisions have been sharply to the downside since September 30th.
Some really interesting observations in there, Jeff, and it's hard to not describe the environment here as I'm looking in December as anything but euphoric, right? I mean, it certainly has that euphoric feel of just kind of everything pushing to the upside, and at some point, it feels like that's too far, too fast. Julius, you now have the bookends of Mish describing, obvious strength and stocks working and conditions that could propel higher. Jeff outlining some of the concerns with the fact that we're trading pretty rich relative to where we've been, potential double top. Or which side would you describe yourself on, or somewhere in the middle, and why?
That's a good question. The first thing the first saying that pops up with me is when Jeff and Mish describe conditions, economic conditions, and you've heard this as well. I think it might even come from Fidelity. I don't know who is, markets are connected to fundamentals, but only by a mile-long rubber band. And I am very, very reluctant to start calling double tops when we haven't even reached the first level of the top, because a double top, in this case, I see where it could be a double top. But the problem is that it will only execute when it drops below 3,500. Until we drop below 3,500, there's no way it's a double top. So that's one thing. The second thing is that if we go above that 4,800 high in the S&P, I think it will be a massive bullish signal. Because what it means is that everybody who sold in that area is now still sitting on some sort of a profit, but not any longer. And especially if they're professional investors, they're in the performance game. So, when we take out the previous high, they start losing money and they need to buy. And if there are shorts, I love the shorts at that level because they're double buyers. They need to buy to cover their positions, then they're break even, they're not making any money, and they're in the performance game, so they need to start buying to catch up with what's going on. So that's, I think, a very bullish characteristic. If we talk about elevated breadth levels, great. I mean, it means more people are participating. And we had a very good discussion last week where we kind of outlined that, because everybody was talking about the Magnificent Seven and it was large cap and it was very narrow breadth because it was only 7 stocks. And now all of a sudden everybody's worried about too many stocks participating. So what does it mean? I mean, what we've described and we've discussed is that it's very clearly now that money is rotating out of large caps, but it's going into mid and small caps. And I think that's actually a good thing. Rotation is the fuel of the market, and instead of only large cap participating, you now see mid and small caps actually catching up. So I think that broader participation is a very good thing. So all in all, I have a very hard time being bearish right here.
All right, really helpful, Julius. Thanks for laying out some of those points, particularly in terms of performance. Mish, could I bring you in? I'm showing a chart here just showing the gap between the NASDAQ 100 year-to-date returns around 55%, the S&P up about 26%. There's small caps languishing around 17%. Still a decent year, I guess, by some standards, but a huge performance gap. When you think about the leadership themes in 2023, particularly the dominance of the mega caps, but how small caps are really started to maybe be a part of the story here in the fourth quarter. Is that an emerging theme we should be prepared for at the beginning of next year, or is that just a temporary sort of fluke in your mind?
Well, it would certainly be the healthiest scenario that we can imagine for the market, to pick up on what Julius said, because the small caps, which of course those of you who follow me know that is the granddaddy of my economic modern family. It's the 2,000 stocks. It's the basis of really the infrastructure, manufacturing, industrial side of the United States. And we haven't seen any real growth, actually kind of going back to Jeff's point much earlier, in that in terms of the economy, we've seen a lot of expansion in terms of PE, but not real economic growth and through earnings. And that would be healthy, right? If we can see those small caps continue to participate. Of course, some of it is just ratio and again, to use something that Julia said, rubber band snapping, when you get those crocodile jaws this wide between growth and small caps, they're going to come in. But as far as the small caps go, it is possible as we're going into 2024, if we can maintain here above, say, 1,800 level or 180 if we're looking at IWM. That would be an extremely positive situation. And we're sitting here right around the 200 level as we speak. And so a catch-up would mean certain opportunities. I think that would also coincide with potentials that I'm seeing for 2024. So I'm hopeful. Yeah, I'm hopeful that small caps stay in the game.
Jeff, one of the, as you're thinking about this idea of leadership, 2023, for much of the year, it's been the mega cap growth stocks and everything else. Is that a theme you see continuing, or is 2024 the year where we start to see a little more diversification, maybe that we started to see here at the end of the fourth quarter?
Yeah, there's no doubt we have seen the market broaden out, but it's the third time this year we've seen that happen. And each time it's kind of stalled out in, kind of the latter innings. And I think it's possible that we're approaching the latter innings of this broadening as well. And there's a couple of reasons I think that. Number one, we haven't seen the NYSE moving balance indicator post a breadth thrust. And that's been one of the key model indicators that I've looked at for a number of years that's actually signaled every single durable advance. And it's failed to confirm other breadth thrust measures that we've seen, for example, the Zweig breadth thrust. Sure. And it'd be very unusual. This is an indicator that goes back to 1965. So that's one issue. So given that, and back to your question, could growth continue to lead? Well, as growth becomes scarce, investors pay any price for it. And so one of the things that I think that we see right now is that the relative strength of growth continues to be strong despite this particular pullback. Value's shown its head a little bit here, and we've certainly seen some value stocks start to participate, but growth continues to lead from a long-term perspective and from an intermediate-term perspective.
Really interesting. What was the name of that breadth indicator that you mentioned, Jeff?
It's the moving balance indicator. It was developed by a guy named Humphrey Lloyd back in the 1960s. He wrote a book about it called The Moving Balance System. I think it was published in 1976. It was a big Steve Leuthold indicator that he used to talk about a lot.
Oh, there we go. I'm thrilled that 23 plus years into this, I'm still learning things most days here, Jeff. Thanks for that gift. That was awesome. I'll have to look into that. Julius, as you were thinking, when you were on our show last week, we talked about small versus large, and it was really more of a small versus large story than a growth versus value story. When we go into the new year, what does that mean in terms of positioning? Do you stick with mega cap names, Metas, and others that are all, just making it new 52-week highs here this week as we're recording it? Or is this the time to think more broadly into other areas of opportunity in the equity space?
I would say the latter. I'd say we need to look for growth names in the small and mid cap segment. And a quick word on the growth value rotation, because you know that I do a lot of that on RRG, showing growth versus value rotations. And there's one particular RRG that I look at a lot, which breaks down growth and value into the three size segments. And where you usually see growth and value rotating in opposite directions, what we now see is that it's a size rotation. And the interesting, if you look at those three blue tails on the left, that is growth small cap, and it's value small. So for the small caps, both value and growth are picking up. And the same goes for the mid cap. You see these the three blue ones those three. That is mid caps, mid cap growth, and mid cap value, where you will see that growth and value are moving in tandem, which is very unusual. And also on the large cap side, you see that value and growth are coming down. Yeah. So growth and value in every segment are moving in tandem. So this is really a size driven rotation and not so much a growth value driven rotation. And I think I had to think twice when I saw this and to figure out what was really going on. And I came to the conclusion that it is the rotation out of large cap stocks is way more stronger than the move of growth versus value. So to your question, I think we should be looking for growth and value stocks in the smaller tier segments. And eventually growth value will start to play a role again. But with this is a weekly RRG. So these rotations take a couple of months before they complete. So I think this will last well into the start of 2024.
Yeah. Mish, one of the things as I'm thinking of, 2023 and looking back, the seasonal tendencies have played out pretty well, right? It's hard to imagine a better fit to the seasonal tendencies in terms of a strong rally in the beginning of the year, a major low kind of in the October timeframe, strong November and December. How much does seasonality fit into your perspective in a year like this, and how much is it something you're thinking about going forward?
Well, before I answer that, I just want to mention something again about the small caps, to Julius's point, in that the small cap stocks that have had solid earnings have done tremendously well. And so if you're going to look into getting more, again, sort of forgetting value growth, but small caps versus growth and small caps that have good earnings, that I think also will continue to be a good place for 2024. So I just wanted to add that.
Yeah, great point.
In terms of seasonality, we have an election year. And I'm sure you can find a lot of data if you just look about how bullish generally that tends to be for the market into a pre-election year. So at this point, just using that and some of the seasonality factors I've read from people who really focus on this a lot more than I do, let's say like a Ryan Dietrich, there's percentages, and when the S&P has performed at X percent by this point in the time, there's X percent chance that the seasonality going into 2024 is going to be positive. If you couple that with the election, it certainly does tend to mean that we're going to see a good year coming up.
Mm.
I'm always going to be somewhat poking my head out because of other factors that we haven't even gotten around to talk about yet. But yeah, seasonality has really proven, especially if you look at things like the Stock Traders Almanac, that it's been incredibly predictive, almost simplistic in essence, which has made it even more beautiful in a way.
Yeah, simple and repeatable is always a great investment strategy if you can find one of those, right? Jeff, you had mentioned some concerns about how extended the market has been. And again, I mean, based on any analysis of trend, it's hard to disagree that we've obviously had an incredible run, not just in 2023, going back for, a decade plus of this run. Just thinking of the beginning of 2024, if things do kind of buck that seasonal pattern and all of a sudden we have a weaker start to the year, what sort of signal or trigger or pattern would tell you, okay, this is the rollover we've all been waiting for? Is there a level on the S&P or a signal that would tell you now you need to get out of the way?
Yeah, it's a great question, Dave. Much like 2021, kind of rallied into a high in the early days of 2022 and surprised a lot of people. And we got something of a, dramatic decline over the first couple of weeks of January. I think it could be something similar to that early in 2024. I'm not necessarily insinuating that it would happen in the first week or two of January, but I think early in the first quarter, I think we could see a top something in the neighborhood of 1% to 2% above the S&P 500's all-time high of 4818. And I've kind of thrown out a number of 4,900, give or take. But I think a break below 4,600 would be the initial indication that the character of the market has changed. And I think if we take out 4,100 kind of definitively this time, we got down to it as far as, the recent lows in October and tested that level. I think if we were to definitively take out 4,100, I think that would be kind of an all bets are off sort of signal. To me anyways. And as far as pattern goes, I think the pattern is very similar to what we saw. If we look back to the 2000 peak, then the 2002 low, and then you had a rally off of that into 2007 that barely took out the S&P's prior high. And then we had kind of a waterfall event shortly thereafter that over the course of a year plunged to new lows. That's the sort of pattern I'm looking for, but at a smaller degree of trend.
No, really interesting, and it's funny as you're talking. I'm looking at the weekly chart of the S&P, Jeff. I mean, it's amazing how the last couple of years, 2022, 2023, they've turned on a dime essentially right at the beginning of the year. That's now become, I feel like, the new normal is some sort of significant move right out of the beginning. Julius, kind of a similar question, right? When you're looking at the strength that we're seeing in stocks up until, sort of mid-December, the seasonal strength that certainly appears to be bullish in the first quarter, what would tell you that conditions are actually getting a little more risk off? Is there a particular signal, a level? Is there something on the RRG that would tell you this is more of a risk off scenario? Like what warning signs would you be looking for here?
Well, when we talk about seasonality, I am totally on board with what Mish already said with the Stock Traders Almanac. When I was in the office last week, I did my 200 show of Sector Spotlight, and I had Sam Stovall as a guest, and he's a great guy on seasonality. So I got a few great takeaways from that conversation. And he also mentioned that November-April period, which is like the strongest 6 months traditionally, and it certainly seems to be working out like that. And the one stat that he brought on, and I wasn't really aware of that, but he brought on the presidential cycle, and he said that election years for first-year presidencies were extremely strong. Since World War II, they had an average return, and I need to speak like over 15%, 100% of the time. So I was like, okay, so since World War II, every election year, for a first-time presidency, and it didn't matter whether he was re-elected or we got a new guy, was 15.5% up 100% of the time. And this also went for the S&P 400, so for the mid caps, and the Russell 2000 had one failure over that same time where it wasn't up. So I think that's some pretty solid statistics favoring, a further rally. Now, if you ask me what is my risk off type label, what I'd like to do is when I look on the RRG, there are three defensive sectors: healthcare, staples, and utilities. They rotate very often in tandem at the same time. So when I see those three sectors getting back in favor, that is something that starts to get my attention as being potentially, we need to look more for risk off signals, markets getting dangerous, et cetera, et cetera. But as long as people are grabbing money out of these defensive sectors while the market is going up, because if they are taking that money out of these sectors and the market's going down, then there's money taken away from the market.
Right.
But when they take money out of those sectors and the market's going up, it means that they are redistributing the money from the defensive sectors into offensive and more sensitive sectors. And I think that that's what we see right now. So I keep a very close eye on the rotation of those three defensive sectors as my sort of go-to risk on, risk off parameter.
Really good point. It's like real estate has bounced a little bit, and certainly on a relative basis, you're seeing them rotate a little bit. But it's funny. One of the ratios I look at, the XLY versus the XLP, and the equal weighted version of consumer discretionary staples. I mean, it really has just pushed to the upside all of a sudden. After being kind of neutral for for 4 or 5 months, December really pushed to the upside. So I feel like confirming a lot of what we've talked about, continuing to show that risk on sort of sentiment.
So, Mrs. Ramos, what does your son do?
He says he sells clouds. He works in a cloud company and sells clouds to other companies.
Mish, when we were talking, just sort of introducing the discussion, you were talking a little bit about interest rates. And when you think about the 10-year yield, it's been, I remember I was interviewed before, I think at the end of 2022, and asked the most important chart looking ahead of time for 2023. And I said the 10-year yield. And I don't know if that was the right answer or not. I feel kind of good because it certainly was important. But it's so funny how the leadership didn't really follow what you'd expect given the interest rate environment. As rates have gone up aggressively, the Fed has been hiking rates. Now all of a sudden we're talking about Fed lowering rates. What does that mean for your thinking transitioning from 2023 of more of a hawkish Fed to 2024, where different conditions? How should that inform your stock picking, your asset allocation?
This is such a great question, and it probably is the question. And I don't want to forget to talk about junk bonds too, as my real key risk factor that I look at, because that's very interesting, sort of supports both points, Jeff's and Julius, in terms of bullish or bearish. But, so let's talk about interest rates. I am a huge proponent of history, and a chart, which I know I gave to you, Dave, came to my attention, which was an overlay of the CPI numbers, which, you may or may not agree that CPI numbers are relevant. They're cooked. We know they're cooked. Actually, a little sidebar story. When I was in Honduras, we walked into a candle soap store, started talking to the guy who was American, and he worked for the government, and his job was to cook the CPI numbers to a point that made them look good. All right. So, I mean, you want to talk about conspiracy theory. There's no conspiracy theory. That's what goes on. But getting back. So this particular chart has the blue, of course, which represents from the 1960s into the early 1980s. The yellow on it, which is this past decade in the 2020s. And it's startling. Look at how startling that is, how it is tracked to a perfect mirror image. So if we peaked in 2022, as we showed, as we peaked in 1975. And then we had this huge drop in inflation in 75 down to 77, as we're seeing now from 2022 now, as we're entering 2024. If we indeed do wind up repeating, what could actually make this go back up in terms of inflation, which of course would then force the Fed to either be somewhat static in not reducing rates keeping them the same or possibly even raising rates. And I think that that's really the question that nobody knows. In terms of a super cycle, people say to me all the time, oh, this is disinflation. You know, Mish, you've just been so wrong about the super cycle of inflation. But what people don't understand is that a super cycle means high volatility, which means you can see 20, 40% moves in commodities. Believe me, when there's a disinflation, you see commodities go flat like they did for so many years, not like sugar that goes up to 28 cents per pound, then goes down to 21 cents per pound in a matter of a month. That tells you the volatility is still there. So going back to this, if we get any kind of super dovish policy, if there's a reason where things look more recessionary, which could still happen, and the Fed is forced to lower rates more, or unemployment goes up, or whatever the reason is, or our money supply, which is so low, needs to be replenished because the Fed is really focused more on actual interest rates in terms of controlling inflation and not money supply, or the debt, which we know in terms of foreign countries had been all that attractive. Any of those things, geopolitics, weather, etc., coups, social unrest, I mean, like the list can go on, would actually make that chart that we showed you have 2024 as the potential low in inflation, which creeps back up, which of course means that inflation once again proves not to be transitory, and two, means that the Fed once again will have to become more aggressive, which of course can then support a much bigger sell-off. But it hasn't happened yet, but this is where the interest rates right now have normalized, right?
Yeah.
At around 5% is not actually bad. This need for ZIRP is ridiculous, and it's not even good for the economy. If we can get used to and keep things status quo, then of course that I think will support the bullish narrative. And that's kind of where we're at right now. We don't know.
Yeah, it's interesting. I mean, Jeff, as you're looking at interest rates, I mean, the Fed, just sort of trend in Fed policy in 2023 is such a central theme for a lot of investors, a lot of movements around Fed meetings. Now all of a sudden we're entering into a very different environment where we have the Fed most likely lowering rates as early as the end of the first quarter and sort of going from there. How does that sort of trend in rates and potential change in rates, how does that inform your thinking about the equity space and potential for upside or downside risk in the new year?
Yeah, that's a great question, Dave. And the way it informs my opinion is that if you take a look at the last three rate cutting cycles, which occurred over the last 3 decades, each one preceded a major recession, 2001, 2008, 2020. And so, I think what it's really telling me is that the Fed realizes that the economy is poised to roll over and that they are preparing to take action ahead of crisis. I think if the Fed were to actually begin cutting at the March meeting, it would be indicative of a full-blown recession underway. We've been in the recession camp for a while. We've been way too early. We thought it would occur in 2023. It didn't. But, are long and variable lags to monetary policy cycles, right? And the question is, is it going to be a shorter duration lag or a longer duration lag? And it looks like it's been a longer duration lag. The problem is, once it does hit, you can't turn it off no matter what the policy action is. It just continues along its merry way for the next 16 months on average. So no matter what the Fed does, they're not going to be able to stop the inevitable. So our position is that we're going to see something of a bear steepener in 2024. We think the new supply of roughly 4 trillion new treasuries that need to be issued over the course of 2024 will put a lot of pressure on the long end of the curve and push rates up over 5% before year end. And we think the Fed's reaction to what we think will be a recession in 2024 will force their hand and probably push them to cut more aggressively than they are indicating at this point. And that the street, which is forecasting 6 rate cuts or more, versus the Fed, which is expected to or indicating 3 rate cuts, the street will probably prove to be correct because the Fed will overreact to weak unemployment conditions and growth conditions that I think are going to rear their ugly head in the first half of next year.
Yeah, it's really, as you were talking, Jeff, I brought up a chart of the S&P 500, a monthly chart, and then the bottom panel, it's the Fed target rate, and just showing the last couple cycles, and there's a pretty good correlation between the markets coming down, rates coming down, and economic conditions, and that's I certainly seems to be a risk going into next year, a risk of some sort. Julius, when you're thinking about the Fed in 2023 versus the Fed in 2024. How have you navigated sort of the uncertainty of that? Talk to me about the importance of understanding or anticipating what the Fed is going to do versus the value of focusing on the charts and how they evolve. Where do you come in on that relationship between the unknowable, what the Fed's going to do, and the knowable, which is price?
You're asking me about the Fed? That's
I did it in a very nuanced way, opening the door for you to describe a resistance to predict what the Fed. Come on, I gave you the question. Go on.
In a very subtle way, opening up for me to say that I don't care what the Fed does.
There we
I
go.
just look at the results.
Yeah.
No, I have to admit, maybe I should look at that more, but it's just not so much on my radar. I like to look at the resulting rates charts. And to that point, there's a few things. First of all, I do think that, I'm pretty bullish overall for the stock market, but the risk is interest rates. So if we look at interest rates, I need to think about when we attended the CMT Association's conference in April. Louise Yamada brought up a very long-term chart of interest rates, which I knew existed. I had it in the back of my mind, but it was one of these open doors that need to be kicked in every now and then to actually realize that it's going on. And I think it's like a 50-year chart. If you go on stock charts, you do dollar TNX and you bring up that really long-term chart, you see that massive downtrend where it's so clear that the bottom is in. And as a matter of fact, we already had like 2.5 years of rising rates. And despite the fact that long-term trend has changed, what I see now is if you stick, this is a monthly chart. Yeah. If you draw this chart and you put a very simple RSI on a monthly scale on that chart, you will see a massive negative divergence. Basically telling me that this rally, although I do agree that this seems to be a very long-term turnaround, it looks as if this leg of that up move is coming to an end, or at least to a pause. And that would then, and I am no expert in that, but it kind of aligns with the rate cut, outlook, et cetera, so for rates to come down. And I think that is what this chart is telling me, that rates have now peaked for the near term. And this is a long-term chart. So it could actually be like, I don't know, maybe 1 or 2 years of at least sideways or down before we resume. And that would then be aligned with a more bullish outlook for the stock market.
No, really well said. Thanks for bringing that up. Go ahead.
Yeah. Well, the one thing is the yield curve remains inverted. That's a weird thing. Yeah. And we started to steepen. Well, not even steepen, like flatten from the wrong side. And now we started to fall back again to more inverted. So that is something that I haven't come to grips with on how to read that and how to interpret that. But that's what it is.
I know being at the CMT event in the spring, that was a great moment. We did a live episode of the Final Bar, watching the whole room of financial professionals wait for Louise to unfold these big paper point and figure charts she'd been maintaining for years and years. It was a pretty cool moment. But she made some really good points on the long-term trend in rates. Rafat Kampora on the stage said the same thing. He described, getting a 10% mortgage on an apartment in New York and hugging his broker. He was so excited that he got such a great rate back here in the mid 80s. So I think that change is not just a 2023 or 2024 phenomenon. I think this is, a broader shift for a lot of investors to try to figure out is what investing in a rising rate environment really means. Now, it's interesting. One of the great inflation hedges I was taught when I was, learning about this whole investing thing was gold, right? Inflation is an issue. You go to gold. It's a great inflation hedge, great place to be. It has not been a particularly great place to be in 2023, but it's starting to show signs of life. And gold, of course, has threatened, if not briefly, made new all-time highs here in the last couple months. We're looking at the GLD. Jeff, as you're looking at the chart of gold, is gold a place to be to ride out a period of uncertainty going into the new year? Or is there a reason why you'd avoid a chart like this, again, testing new all-time highs?
No, Dave, gold is actually our top actionable trade idea for 2024. We think the breakout above 2,000 on a monthly closing basis was significant. And we think eventually, it may take a few more weeks, but we think eventually gold will break out sustainably to new all-time highs. And we should see the barbarous relic, as it's been called from time to time, push up toward about 2,500, give or take. One of the things we like about gold in this environment is that gold represents hard money. It's the ultimate hard money asset. And as a result, it represents a terrific hedge in both inflationary and deflationary environments. And so we think gold is a core holding for 2024. We've been advocating a 20% asset allocation to gold.
Very, very interesting. Mish, would you agree that gold is a decent place to be, or no, and why?
100% agree. Jeff and I are completely in line. I mean, in fact, Dave, when we did this coming into 2023, I said that gold was something that I wanted to have and as a buy and hold asset throughout 2023.
Yeah.
At the time, it was trading at around, 1,1700, made that rally in December of 2022. And here we are at 2,000, still holding gold. Yes, I mean, everything that I've just talked about in terms of the super cycle, in terms of the potential misstep with the Fed and recession versus inflation, in terms of the geopolitical situation, in terms of the fact that the West is very underinvested in gold, where the rest of the world has a lot of it. The fact that at this point where we're making new all-time highs in certain indices, gold is over $2,000 an ounce.
Right.
I thought it would double coming into 2023. I could have been a little bit early. But I definitely think that we're going to see at some point somewhere between $3,000 and $3,600 gold. I can't tell you exactly when, but I have not changed my mind about that at all.
Yeah, I remember that conversation. It's really, and at times in 2023, it's felt like gold was just completely off the radar. But again, don't look now. It's right back at new all-time highs, or very, very close to that. Julius, do we have a trifecta of gold bulls on the panel? Would you agree gold a decent bet here? Yes, no, and why?
I wish I could go against it, but I can't. It's
just for the drama it would create.
Just for the drama and just for the sake of the argument and the conversation. But this is I totally agree with like that, 2,000, 2,100. That's a massive overhead resistance area. If that gets taken out, then the only way is up.
Yeah. And it's amazing how gold stocks as well. I mean, one of the areas of the market at times underperforming dramatically, but in the fourth quarter rallying along with everything else. A lot of those gold names are making new swing highs here in December. Can we talk briefly about cryptocurrencies? We're getting toward the end of our conversation, but it's hard to have a market outlook discussion and not talk about crypto in some way because, of course, it's become a pretty it's had an incredible year. 2022 was the year to stay out of the way of Bitcoin plunging down to the teens in the thousands. But all of a sudden, it's aggressively gone up in value, almost tripling in value here in 2023. Julius, sticking with you, Bitcoin bullish or bearish here certainly seems to be an uptrend as we're going into year end. Would you agree it's a good place to be going forward?
Yes, especially if you take a little bit longer term outlook. I do a lot of commentaries on crypto for stock charts with various media, and my price target near term is 48,000. That's the first high that you got back, and then the next one is all time high levels. And if that gets taken out, this crypto market is a crazy place. So if they move, they move. And, so a couple of $1,000 in Bitcoin is absolutely nothing. It can happen overnight. So I'm looking 48K, if you look at the RSI right now, it looks a little bit overstretched, so we may see some sort of a setback. But I think in all, buy the dips in Bitcoin. 48K. If we take out 48, it's going to be 66. And after that, who knows where I'll go. But I'm a pretty big crypto bull right now.
Mish, I'd love to know if you agree with that. And obviously, one of the big narratives we've been hearing more and more is the possibility of ETFs coming out with the ability to actually, have more of a direct investment into Bitcoin for a whole cohort of investors that have not yet done so. Does that keep propelling Bitcoin higher going into 2024, do you think?
Stop. Do not invest in another company until you hear about America's #1 retirement stock.
Well, actually, it could have, once it's past the reverse effect, it could actually cause a sell-off in Bitcoin. But let's go back, I think, to the last time I was on Final Ball with you. We were talking about 28,000. Do you remember this, Dave? I know you do some shows.
Yeah.
But we both said 28,000 breakout, just follow it. So, hey, we look pretty good right now, right? So I totally agree with Julius. There's something else coming up this year. It's the halving of Bitcoin. It happens every 4 years. When you've had over the course of the 4-year periods an accumulation period of Bitcoin like we're seeing now, generally that tends to be a very bullish event. Of course, we'll see what happens with the spot ETF. I mean, 48 maybe. I mean, to me now, I look more at support levels than I do at resistance levels when you talk about something like Bitcoin. So 38,000 to 40,000 would be my rock bottom support right now. But what is interesting is Coinbase. I mean, that has just been, I smile to myself a little bit because I've been very bold in the call. And once that 28,000 was taken out in Bitcoin, we bought Coinbase. It did nothing. It sat between $70 and $80 a share. And now it's trading at $168 a share. I bought it at 80. So, I mean, that's why I smile to myself, because it's great to predict rising growth stocks, Amazon, all that. And they've gone up 20%. But this has gone up 100%. So if that doesn't tell you that ETF, of course, on mass adoption could be a good thing. Holden Milson, who is our crypto expert, thinks that though it could cause a little bit of a sell-off with the announcement of the spot ETF. Nonetheless, overall, you have to say that this is the teenager of my economic modern family, 18, 19 years old, still trying to figure out what it wants to be when it grows up. And right now, it's kind of showing that it really likes being sort of the decentralized coin. And in the gold and Bitcoin conversation, we're not hearing as much. It certainly will continue to have its place.
No, some really good points in there. And you mentioned just the magnitude of some of the changes you get in the crypto space. Coinbase had doubled just off of that basing pattern. This was a chart we reviewed earlier, guys, about looking at the NASDAQ and how it dominated returns versus others. But all we need to do is add something like, like GBTC, good proxy, and the closest we have to a Bitcoin ETF. And if we overlay it like this, you'll find it spikes way to the top, up 338% compared to the NASDAQ's swarthy 55%. Jeff, I mean, when you're thinking about, cryptocurrencies, obviously this is an area of the market very new, but it's become less and less new, now becoming a little more mainstream in terms of the discussion. But I know a lot of investors still apprehensive. It's still a less opaque and less accessible market. Do you see something like Bitcoin as a foundation to a portfolio, similar to what you talked about with gold? Or is it still sort of the Wild West in your opinion? And what's your perspective there?
I'm more of the Jamie Dimon sort of opinion. I don't see a real utility for Bitcoin whatsoever. I don't think we're going to see broad adoption institutionally. There's already a contract that trades on the CME and the CBOE, I believe. And so, it's not getting tremendous attention. I'd also say with respect to the ETF, you punched in GBTC, which is not an ETF, but it's a tradable trust of Bitcoin. Basically the same thing. It trades at a slight discount to NAV. If we have a spot ETF, it simply means that you're not going to have to deal with that premium discount like a closed-end fund would. But at the end of the day, you still have a tradable proxy for Bitcoin right now. So I don't see how the ETF is going to change it dramatically. GLD, for example, wasn't an ETF initially. Eventually, it became an ETF. It didn't really change the dynamics. But with respect to levels, I can't disagree with Julius and Mish. I think a breakout above 48,000, and we probably challenge the all-time highs.
Yeah.
So for traders that, are really just not interested in the underlying, collateral that they're trading, and you're just trading a price move, then that's probably a worthwhile speculation. For institutional investors who are building long-term asset allocation portfolios, I just don't think Bitcoin's ever going to get a serious allocation of institutional assets.
Yeah, no, a ton of really good points in there. And I love you sort of implied, which I totally agree with, Jeff. It's sort of a petri dish for behavioral biases and where technical analysis arguably has an incredible value is a market like that where there's very little fundamental data to really consume. At the end of the day, it's a proxy for speculation for now. Certainly seems to be going higher. Appreciate all your points on that. Guys, we're to the end of our market outlook, and so I wanted to finish off with just a quick lightning round, if that's okay with you guys. We're going to keep your answers quick, like 5-10 seconds, just brief thoughts on each one of these points, but I'd love to just know how you would answer maybe 4 or 5 brief questions. First off, let's talk sectors. What would you think will be the strongest sector in 2024, and why? Mish, why don't you start us off?
Well, I'm going to go with precious metals because it's a safe answer.
Yep. There we go. Keep it safe. But again, your points on gold, well taken. I think there's upside to be had there. That's certainly a play to focus on. Jeff, how would you answer that? What would you expect to be the strongest sector in 2024 and why?
Well, I think the defensive sectors have a lot of room for alpha, staples, utilities, healthcare, REITs. We're starting to see them rotate into the improving category right now. I think that could extend, especially if we're correct about our view on the market. We think, we will see a lot of capital rotate out of tech, out of comm, out of discretionary, and into the defensive sectors. By the way, healthcare has the highest upside revisions to earnings for 2024 right now.
Interesting. Julius, what would you say top sector for 2024?
Consumer discretionary.
Got it. Go with the consumer. I like it. And maybe continued offense working in the new year then.
Yes. And the reason is I'm looking at a monthly RRG, and there you see consumer discretionary actually, it's in improving. It's starting to accelerate into leading. So we're talking about the entire year of 2024. So I got to go with that longer move, and it seems to be discretionary for me right now.
Well said. I'd love to ask this question, most important one in my opinion. What's the one chart you would use today besides the S&P 500? What's one other chart that you would want to have in front of you to get a good read for the market as it evolves? Mish, what would you say?
I love junk bonds. A lot of people don't really pay attention to them or even understand them. Obviously, high yield, high debt. And I think it's an incredibly important chart to watch because even though it's made a move up, and it kind of told us in October that the market had bottomed, if you look back at where it peaked out in 2022 before the market crashed, it is nowhere near there, which means it's still grossly underperforming the rest of the market. So that has 2 warning signs. Number one would be that it has a lot of catch up to do, which of course would be extremely bullish. Or if it starts to roll over, things have gotten too frothy and we've gotten too euphoric. So I have my eyes on HYG always.
Perfectly said, and a great way to think about risk appetite out there for investors. Great point there, Mish. I like that one. Jeff, what would be that one chart besides the S&P you would want to have in front of you in the year to come?
Yeah, W.D. Gann put out his financial timetable in 1909, and we have an updated version of it, which actually extends out to 2121. And what it really does is it looks at Gann's 18.6-year lunar declination cycle. And it's a complicated explanation that we don't have time for. But what I think is interesting is 2024 is redlined as a major panic/crash year to be followed by 4 years of declining stock prices that should bottom in 2027 at an extreme low. I think that should not be ignored considering how many great calls Gann has made in the past by using this very cycle chart.
Interesting, Jeff. I certainly hope we'll have you on the final bar in the new year. Maybe we can dig into that a little more because I think that's an interesting one to think about. Good contrarian view relative to the current upswing. Julius, what would be your one chart that you would have in front of you to navigate this market?
So that would be a weekly RRG of the equal weight sectors.
Okay.
Equal weight because we're going into, getting out of that large cap stuff. So the equal weight gives you a little bit broader sense of what's going on. And I think that'll be a very good chart to help people keep an overview, a higher level overview of what's going on. So that would be my go-to chart if I had to choose one for 2024.
I'd be so disappointed if you didn't answer some sort of RRG, Julius, having created it yourself. But I like that answer about the equal weighted version. That's actually one that I don't review as much that now I'm thinking I definitely should. Great way to sort of get that mega cap bias out of the way. Guys, That's it. That flew by. I feel like so many points you guys made were well taken. I was taking notes the whole time, and I filled some pages with comments that you made, with points that you made, with charts that I want to go back and review. And I know our viewers really appreciate just an opportunity to hear how you guys are navigating this sort of market. So Mish Schneider, Jeff Hughes, Julius DeKempener, thank you guys so much for joining us. Thanks each of you for being frequent guests on the Final Bar. I hope we can keep that going in the new year. But until then, happy holidays to you all.
Thank you, Dave.
Thank you, Dave. Thanks for having me on the show.
Yeah.
Folks, that's it. What a fun discussion. Again, what a pleasure to be able to sit down with three really knowledgeable experts. And again, I think you heard some varying opinions. You heard some optimism, some signs for pessimism, some levels and patterns and signals that you want to review. And hopefully you caught along the way how stock charts, I hope, is a part of your risk management and idea generation process in the new year. By the way, we have our holiday special going now. So make sure to go to stockcharts.com/special to lock in a good deal for your membership to stockcharts.com. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe. Happy holidays, happy new year. We'll see you live in 2024.